Hello, 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 hello. What's going on, everybody? Welcome to Al Stock Trades. How's everybody doing today? All right, so I was not going to be making a live today, but I was able to squeeze one in here. So let's go ahead and just kind of do a little preliminary talk about what's going on. So it's 252 Arizona. So that makes it what 3, 4, 52. So we're gonna pretty much they're gonna about to get started in about 8 minutes. So we have about 8 minutes. So again, nothing we say is financial advice. This is all just for educational purposes. What I wanted to go ahead and do right now is just kind of go over just what I basically see here. Um, so this is actually quite interesting. So third quarter 2025, they grew 35%, but the revenues grew, total third quarter revenues up 50% year over year. It's pretty much almost like, Clover said, you know what, this year's pretty much shot when it comes to EBITDA. And next year is going to be 4 stars. And with this Part D issue, let's just go ahead and grab as many people as we can now, and let's put them through the Clover system so they can ultimately end up basically decreasing the medical cost, right? So what ended up happening here is the GAAP net loss was 24 million, and the adjusted was 2 million. So a lot lower than what was anticipated by Clover. So they had to revise downward, right? And they could go ahead and pretty much basically show you the insurance expected BER and all these things. But I think this is a terrible way of looking at it. If we're really going to want to look at it, I think the best one is this guidance here, which is this is a great way of looking at it. So in terms of revenue, they're expecting revenue now to be higher than what they initially guided for. So they're going to basically get more lives. Interestingly, SG&A actually went down. So that somehow they're able to decrease SG&A. And it's about 17 to 18% of total revenues, which is a lot better than what we expected. Now, the only issue here that's hitting Clover is the adjusted EBITDA and adjusted net income. You can see they had to revise downward, but they revised upward from the bottom end, their average Medicare Advantage lives. But the insurance BER went up. Now, what's interesting here, if you look a little closely, they say here, this is something that I want to basically read into here. Let's can we zoom in? Let's zoom in. It says, despite these pressures, our underlying incurred medical cost trend, excluding pharmacy, was 4%, while growing membership 35%. That's actually pretty good, right? Given our strong member retention and profitable returning member cohorts, we anticipate profitability improvement in the years ahead as new members mature into the cohort. So it looks like, again, it's that Part D, which that headwind is going to turn, it's going to disappear hopefully in 2026, given the Trump administration's area on this, right? So you have that, okay? Now let's go ahead and take a look at the 2026 financial outlook. It's quite interesting to give an outlook, for 2026. While the company expects to provide formal full 2026 guidance next year, Clover anticipates the following profitability drivers to achieve full year GAAP net income. So I don't think people are basically looking into this right now. And I think people are I think people are, again, I get it. I get it. It's just, it's life is hard. Life is hard. Okay, guys. So, last quarter when, and I wish I had the camera on, again, guys, it's just, I wasn't going to make a live today, because of the whole, my schedule. So my apologies for that, but I just wanted to just point out something. The last time we had the earnings, it fell down here. Remember, $2.18, 17 cents, and then Vivek bought. I just need to read this to you guys, okay? Because sometimes people again, life is tough, okay? And understand that from an educational, I'm going to remove the comments here so we can actually read this. From an educational perspective, I'm here for you guys, right? And we're going to go ahead and we're going to learn how to read this together from an educational perspective. And, we're going to go ahead and kind of, understand, right? So I'm this is very exciting. This is better than any textbook. This is real life data. And I mean, what better way to learn? So listen, I'm going to read this loudly, okay? And I'm going to change my tone, okay? While the company expects to provide formal full year 2026 guidance next year, Clover anticipates the following profitability drivers to achieve full year GAAP net income in 2026. What does that tell you? I'm just going to repeat it again, just in case. Full year GAAP net income in 2026. Okay. Now again, I was on my phone here as I just kind of go quickly through the computer here. So I'm operating on less amount of screens here because I'm not in my normal setup. Okay. I'm not in my normal setup. So I'm really sorry if the live is a little weird. I don't have my full screen set up that I'm normally used to, given that I was not, right. So listen, it says here, full year GAAP net income in 2026. Now, I find this interesting because if we don't recall, we actually sniffed this in our terminal, which I found really interesting. I couldn't believe it. But now looking at it, and then it's coming from the horse's mouth, there it is, right? So if we go ahead and look up Clove right now quickly using the terminal, and then go to institutional, no. Go to analyst estimates, and then go to net income here. You could see 2026, they're expecting them to be positive. Even here, right? Look at the 2026. So analysts are expecting them to be profitable in 2026. And you can see here, full year GAAP net income. Following profitability drivers to achieve full year GAAP net income. Again, full year. That is big, right? And again, a lot of people are missing this because they're just focused on the stock price. They just see the stock price, and again, a lot of people are selling, right? And a lot of gazelles are getting eaten right now, and it's it is what it is. I've talked to a lot of people in public, and I always like to get sample size data. And sometimes there's people that want to be poor for the rest of their lives, and others that are fixed mindset versus growth mindset. And it is what it is. But it's really it's just like look at institutional ownership, guys. I mean, come on, right? Let me go ahead and just really broadcast here. Just make sure. Hold on, I got to make sure the broadcast is good. Okay, good. And it looks like Clover Health is making the broadcast freaking sexy. So they've updated their broadcast. But anyway, look at institutional ownership increased by 40%. Like that's a lot in here. So again, I want to repeat, full year GAAP profitability, and it looks like in 2026. So favorable financial impact related to the upcoming 4 stars. And who knows, they might be able to get rejected from 3.5 stars to go to 4 stars. But they also basically said that the 4-star, that the 3.5 star downgrade in 2027 is not going to affect them because of their counterpart. So you have SaaS coming involved, right? So then you have the favorable 2026 CMS final rate update, which is going to be great for us. And then there's going to be another final rate update. Then the increased Part D direct subsidy. Right? Can someone just make sure that I don't someone like comment and say, hey, Al, I'm keep listening, but like I say, hey Al, they're live right now on the broadcast because I want to get, it's 3:00 right now. So we have 451 viewers, 201 from YouTube, and about 251 from Twitter. Just okay, you know what? There's other things I want to talk about, but let me just go to the one that really made me smile. Look at the treasury stock, right? We would have to extrapolate it from last quarter to determine, but look, they bought more shares. They bought more of their stock. Instead of selling it in the open market, they bought more of their treasury stock. Okay, it's starting? No? Okay. They bought more of their treasury stock. You understand that? So again, guys, I would say, you know how I said 2024 was the year of concept, the proof of concept? 2024, and we saw it, 60 cents to $4.86, right? 2024 was the year of proof of concept. 2025 now, honestly, when I'm looking at it, it's the year of institutional transition. It's the year where retail investors basically fork up their shares to institutions, and that basically lowers the float, right? Um, and then, yeah, so that's pretty much it right there. Yeah, I'm just looking at the live to make sure. Yeah, so again, so I think this year is going to be the institutional transfer. Just retail investors that don't know what the hell's going on. It seems to me, again, it's going to be a triple dragon next year, but the triple dragon may not be as big as what as what we might expect. At least it's going to be a triple dragon. In terms of operating cash flow, I don't think it's that good. They're operating cash flow positive this quarter. But if you subtract it from properties, plants, and equipment, it's actually going to be negative. So they still have unpaid claims, a negative 15 million. So they're paying a lot of these. Let me go to the cash flow really quickly. Just so we just kind of say it all in here. So they're burning, obviously, more losses this year than last year, as anticipated with the growth rate in Part D. The unpaid claims is 15 mil, which is a lot. Obviously, they're paying out claims and they're still operating cash flow positive. But if you subtract property, plants, and equipment here, there's still going to be negative free cash flow. But again, listen, they're at zero. They're at zero, like literally near zero free cash flow, which is good, right? It's not like negative 200-300 million like how they used to be, right? So again, I'm really excited for this endeavor. A lot of people are, I've seen comments which I don't know where they are now, but okay, we're live here. Hold on, guys. Hold on. Let me unshare the screen.
Joining me on our call today to discuss the company's third quarter 2025 results are Andrew Toy.
Please let me know if you hear him. Please let me know if you hear this.
Clover Health Chief Executive Officer, and Peter Kuipers, the company's Chief Financial Officer. You can find today's press release and the accompanying supplemental slides, as well as the company's most recent investor deck in the Investor Events and Presentations section of our website at investors.cloverhealth.com. This webcast is being recorded and a replay will be available in the Investor Relations section of the Clover Health website. I'd also like to caution you that we may make forward-looking statements during today's call that are subject to risks and uncertainties, including expectations about future performance. Factors that may cause actual results to differ materially from expectations are detailed in our SEC filings, including in the Risk Factors section of our most recent annual report on Form 10-K and other SEC filings. Information about non-GAAP financial measures referenced, including a reconciliation of those measures to GAAP measures, can be found in the earnings materials available on our website. With that, I'll now turn the call over to Andrew.
Thank you, Ryan, and welcome everyone to Clover's third quarter earnings call. There are three main areas I want to focus on today. Firstly, that our growth engine is running well and we remain focused on growing sustainably and profitably. Secondly, taking everyone through the drivers of our lowered guidance for 2025 adjusted EBITDA profitability and what we're doing to address it. In short, we do see broad systemic utilization pressure, but this is also compounded by our growth. We feel we can address this, but it did hit us significantly in 2025 because of that growth. And thirdly, talking about our recently announced star ratings and how we intend to ensure we can grow profitably, whether at 3.5 or 4 stars. Overall, I want to say this. We missed our targets on both overall adjusted EBITDA and stars. While we will remain profitable and growing, these misses aren't at all acceptable to us. They do not capture our aspiration or bar for the company. We can and will make quick adjustments. The good news is that Clover Assistant remains incredibly strong as our core driver. Our CA managed returning cohorts improved year over year. CA also enabled Clover to be the top PPO in the country for the second year running on core HEDIS clinical quality scores. The bad news is that while we did plan for growth and utilization headwinds, we clearly didn't factor those in strongly enough or manage those tightly enough in the non-CA population, which definitionally includes the new members. So those areas are where we're going to intensely refocus going into 2026, which I think is going to be a big year for Clover. Okay, going into more detail. For the third quarter, we've remained adjusted EBITDA profitable on a wide network while growing membership by 35% and revenue by nearly 50% year over year. That does meet our goal of profitable growth. Other plans which grew this much on the PPO have been pushed into retreat. That said, I want to note that we did originally enter this year intending to have significantly higher overall adjusted EBITDA, even with the growth. Ultimately, this adjusted EBITDA pressure came firstly from the higher than expected proportion of new members and the fact that we didn't bring them under management as quickly as we originally planned. And secondly, we saw increased utilization across both medical expenses and supplemental benefits, similar to others in the industry. I'm going to focus on the first, and Peter will discuss more on the second. On an adjusted EBITDA basis, our returning members continue to have a contribution profit, but this did not fully offset the dilution from our larger than expected new member growth. While we had anticipated this pressure from returning to growth, we captured additional market share as competitors retreated, with the market disruption effectively accelerating our growth. This has led to reduced adjusted EBITDA profitability as the cost profile of first-year members, which we see as a combination of marketing, commissions, and first-year MedX, puts pressure on our results. For the full year 2025, we now expect to add roughly 44,000 gross new members within an expected year-end 2025 population of approximately 113,000 net members. This has had a meaningful impact on our 2025 adjusted EBITDA profitability as we are scaling from a relatively smaller base and new members are generally loss-making for us in the first year. That said, our cohort experience and strong historical retention demonstrates that this large new population will bring a larger contribution profit positive base of returning members in 2026 and beyond. We also expect 2025 to be the peak year for this kind of effect. In our modeling with our latest cohort data, we expect that we will be able to continue growth and have meaningful adjusted EBITDA profitability starting in 2026. That was our goal for 2025, but we were extrapolating new member performance as this was our first year of significant growth. Now that we have that under our belt, we feel more confident in our views on 2026 and beyond. Ultimately, we believe the fundamentals of our business remain strong, and the margin pressure we're seeing this year is driven by cohort dynamics. Each new member represents strong long-term value, but requires time to come under full Clover Assistant management. While that dynamic compresses margins in the near term, it's exactly what we believe builds the foundation for margin expansion and accelerated growth in the years ahead, where we anticipate rapid improvement in outcomes and cost performance in our cohorts. Said differently, our returning Clover Assistant managed members remain strongly profitable and are effectively funding this reinvestment in acquiring and developing new member cohorts. Our confidence in Clover's trajectory is rooted in a simple truth. We believe that our model delivers better Medicare Advantage results for more seniors. Clover Assistant is designed to identify and manage disease earlier, providing a multi-year improvement to total cost of care. When paired with our care delivery assets and the close partnership of our Clover Assistant using network providers, we see consistent medical cost management year over year. We're continually focused on increasing physician adoption and remain on pace with increasing our Clover Assistant coverage across the book, with more than half of our new members already having received a Clover Assistant visit this year, which is consistent with our internal targets. The combination of strong retention, more members, more CA-engaged physicians, earlier disease detection leads to strong returning member cohort performance and reinforces the strength of our model and our ability to help manage conditions earlier and better for our members. Next, I'd like to discuss the current annual enrollment period. While it's too early to provide an AEP update in detail, I would preliminarily note that we remain on track to once again deliver strong above-market membership growth and retention within our priority markets. These markets are the ones where we have strong CA network coverage, an existing membership base, and our home care capability. Our plan offerings reflect exactly what Clover stands for: low out-of-pocket costs, physician choice, and real value for seniors. While most of the industry is pulling back and narrowing networks, we've doubled down on maintaining a comprehensive PPO portfolio that prioritizes open access with stable, predictable benefits. We believe seniors deserve choice, access, and simplicity, and our 2026 plans deliver all three. Turning now to star ratings. We received a 3.5-star rating for the 2026 ratings year. This does not represent our aspiration. We want a 4-star plan. That said, let me start by explaining how our model is built to perform well even in 3.5-star payment years. Firstly, we do not view the star rating as an inhibitor for growth. Medicare eligibles are attracted to low out-of-pocket costs with wide physician choice, and based on our experience, we anticipate strong attraction to our plans on that basis, independent of star rating. We also don't perceive the star rating as a true measure of overall healthcare quality. Our focus remains on delivering meaningful improvements in care and outcomes for our members, and one way this commitment shows up is in our HEDIS results. Clover Assistant once again powered Clover to the top of the industry for clinical quality with a HEDIS score of 4.72 for our PPO plans, making us the highest performing PPO in the country on HEDIS measures. This reflects the consistent, data-driven care delivered through our technology and physician partnerships, which continue to improve members' health in measurable ways. So while our focus remains on driving better patient outcomes, we believe that the current star ratings framework does not fully reflect the clinical quality of care our members receive. We continue to actively engage with CMS to advance how quality is measured and remain committed to working constructively toward a methodology that better captures true performance. Ultimately, though, we want a 4-star plan. We are walking through all areas that we underperformed on and making sure that we have plans in place, plans that also incorporate the significant growth that we have had and will continue to have. For example, while we were the top-rated PPO plan in the country on HEDIS quality, we were greatly let down on our star scores because of very low 1- and 2-star scores on our pharmacy measures. We are very focused here and are intent on improving our performance in this area going forward. Now I'll provide a Counterpart Health update. The new organization continues to make strong progress expanding both the reach and capabilities of our technology. During Q3, we've rolled out major new capabilities such as integrated scribing and generative AI tools that help physicians better prepare for visits, reduce administrative burden, and stay focused on patient care. Also powered by CA, and as I mentioned earlier, we've achieved industry-leading clinical quality HEDIS results for the second year in a row, and we've made this capability available as part of Counterpart's new enterprise offering. And lastly, we're seeing good demand, and so we've expanded our go-to-market team and leadership to support new partnership opportunities with provider groups, health systems, and both regional and national payers. Together, these advancements further establish Counterpart Health as a leading technology partner for value-based care. The key for Counterpart is this. Since its launch last year, we have seen tremendous resonance with health plans because our technology provides a capability to them that they've never had before. This capability is to engage smaller, independent doctors who typically manage around 20 to 30% of a given plan book. These doctors are often great physicians, but do not have the infrastructure to be successful in value-based care, and almost no plan has a strategy to successfully engage them. Counterpart deployments have now shown in multiple states and for multiple customers that we can effectively serve this market, and we've heard that resonance with our target customers. We believe this remains a huge blue ocean opportunity for us and provides us the opportunity to bring our technology far beyond the reach of our owned and operated plans. In overall summary, our long-term trajectory is unchanged. Our technology is scaling as we aim to empower more and more physicians with Clover Assistant, and we're focused on growing our profitable returning member cohorts. We anticipate having a large contribution profit positive base of returning members in 2026 and beyond, which will fund future new member growth. This year is just the start of that arc, and while we have several areas we need to improve, I feel strongly we are on the right path. I'll now turn it over to Peter, who will walk through our financial performance in more detail and how we're positioning the business for adjusted EBITDA profitable growth in 2026 and beyond.
Thank you, Andrew. Before getting into the financials, I want to reiterate Andrew's comments that we remain confident on our long-term trajectory to achieve sustained growth and expanding profitability. Despite increased utilization and margin pressure from a higher than expected mix of new members relative to our returning base, our year-to-date underlying incurred medical cost trend, excluding pharmacy, for our entire population remains strong, with a 4% increase year-over-year. We are pleased with this strong cost management, but this trend has run above our initial expectations. Combined with 35% membership and 39% insurance revenue growth year-to-date, we have maintained positive year-to-date adjusted EBITDA and adjusted net income. As we move into 2026, we expect to build on our profitability base with several clear tailwinds impacting our model, including strong member retention, our anticipated larger profitable returning member cohort, financial benefit from our increased payment year 2026 4-star rating, further enhanced and expanded Clover Assistant capabilities, our ability to increase PCP user adoption of Clover Assistant, and continued operating leverage gains as we scale. We also expect to benefit from a favorable CMS Part C rate update and an increased Part D direct subsidy. Taken altogether, we believe that Clover is well-positioned for above-market growth and increasing profitability through 2026 and beyond. Most importantly, we expect to benefit from the strength of Clover Assistant and our returning member cohort management. As this year's large group of new members mature into returning members in 2026, our data has shown meaningful improvement as members mature within our care model, with roughly a 700 basis point improvement in MCR between year 1 and year 2 cohorts, and a 1,400 basis point MCR improvement by year 3 on average. Notably, we deliver more contribution profit from our profitable returning member cohorts than our new member cohorts. Returning member cohorts during the third quarter year-to-date 2025 period have generated approximately $217 of contribution profit per member per month, as compared to a negative contribution of $110 per member per month for the new member cohorts, respectively. For this reason, as new members mature into returning cohorts and we get more members under Clover Assistant-powered care, we are confident to deliver strong financial performance in the coming years. We also have conviction in our ability to deliver continued strong returning member retention in 2026. First, due to the continued industry disruption from competitor pullbacks that Andrew discussed. And secondly, we believe that our current 2025 retention rate remains industry-leading above 90%, reflecting the success of last year's AEP period and our ability to continually retain members. Both of these dynamics together reinforce our confidence to better manage next year's membership mix and continue improving profitability as our cohorts mature under Clover Assistant care management. Furthermore, our model is designed to perform profitably even in 3.5-star payment years, with 4-star years serving as upside rather than a dependency. We continue to see strong member demand for our wide network PPO offerings with low out-of-pocket cost, and our HEDIS score of 4.72 demonstrates that Clover Assistant consistently drives top-tier clinical quality and outcomes across an open access PPO network. Taken in aggregate, driven by Clover Assistant and our differentiated model, our current view is that we expect to achieve full year positive GAAP net income in 2026 as our maturing returning member cohorts and our technology-centered approach further enhance performance and expand margins. Now, returning to the third quarter financials, Clover's Medicare Advantage membership grew 35% year over year to over 109,000 members, delivering insurance revenue of $479 million, an increase of 49% year over year. Year to date, insurance revenue was $1.4 billion, up 39% year over year. Next, I'll discuss the margin pressure we observed in the third quarter. Despite an elevated utilization trend and more new members compared to expectations, our year-to-date underlying incurred medical cost trend, excluding pharmacy, for our entire population remains strong with a 4% increase year over year. On an adjusted EBITDA basis, returning members continue to be accretive to contribution profit, although this impact was partly offset by a negative contribution profit from our new member cohort. Impacting this trend is stronger than anticipated intra-year new member growth, as we are expecting to absorb more than 44,000 gross new members this year from a relatively smaller returning member base. This stronger growth was impacted by other plans dramatically shifting their offerings in 2025 by reducing benefits, shutting down commissions, and fully exiting markets earlier this year, resulting in lower new member core performance than initial expectations. Specifically, medical costs in the third quarter were impacted from unfavorable claims development related to the first half of 2025 dates of service. We saw higher medical cost trends across inpatient and outpatient services related to a number of high-cost claims, outpatient oncology, and inpatient cardiac and surgical procedures. This is consistent with broader industry reports related to elevated hospital utilization in recent months. Importantly, we feel that we have adequately accounted for these trend developments in our updated 2025 guidance. Turning now to Part D. Comparing year-over-year performance is structurally difficult given the changes in the IRA this year. That said, the continued Part D pressures that we and others in the industry discussed last quarter are higher versus expectations. We feel that we've performed well on Part D this year, but we expected and intend to do better. In particular, we have seen pressure in branded and non-formulary pharmacy spend. For this reason, we have launched ongoing initiatives around medication reconciliation, generic substitution, and care coordination to optimize Part D in 2026 while maintaining access, and we feel confident that next year's higher Part D direct subsidy will also help normalize the pressures across the industry. And lastly, we've seen some abnormal activity within both dental and DME that we're actively addressing and pursuing recovery and improvement activities for. We do not believe that this abnormal activity will persist into 2026. On a reported basis, year-to-date BER was 89.4%. This is a year-over-year increase of 880 basis points compared to the prior year period. That said, I want to emphasize that after normalizing for prior year developments in both reporting periods, year-to-date BER increased by 400 basis points. Moving next to SG&A, we continue to execute well with cost discipline, generating strong operating leverage. Third quarter adjusted SG&A totaled $71 million, or 14% of revenue, representing a 440 basis point improvement or reduction year-over-year. Year-to-date adjusted SG&A was $237 million, or 17% of revenue, improving 370 basis points year-over-year. As discussed previously, our ongoing vendor contract reviews and negotiations, with a focus on improved SLAs and benefits from pricing at scale, are continuing. Our progress highlights the operating leverage we're achieving, even as we continue to invest in growth, technology, and higher quality care management. Despite the aforementioned margin pressures, we have achieved both positive adjusted EBITDA and positive adjusted net income year-to-date. This underscores the resilience of our model and our ability to manage costs effectively while scaling the business. Both adjusted EBITDA and adjusted net income for the third quarter were $2 million, each down $17 million year-over-year. Year-to-date adjusted EBITDA and adjusted net income remain positive at $45 million and $44 million, respectively. Our year-to-date adjusted EBITDA profitability, despite a higher proportion of new members relative to returning members, underscores the scalability of our model and our disciplined execution in managing our strong returning cohorts. That said, we do expect the elevated trend we've experienced during the third quarter to continue in the fourth quarter, along with typical fourth quarter Medicare Advantage seasonality. Moving on to the balance sheet. We ended the third quarter with cash equivalents, and investments totaling $396 million on a consolidated basis, with $123 million at the unregulated subsidiary level. During the third quarter of 2025, cash flow from operating activities was $12 million. We expect that our cash balances will remain strong for the remainder of 2025, which will allow us to continue to operate from a position of strength as we invest in our growth model in 2026 and beyond. Importantly, we believe that we will continue to be self-funding as we execute on our growth strategy. Turning to guidance, we are revising our full year 2025 outlook to reflect the membership growth and utilization trends we've seen year-to-date. We are increasing our Medicare Advantage membership guidance to now average between 106,000 and 108,000 members, reflecting 33% growth year-over-year at the midpoint and continued intra-year growth this year. We are increasing our insurance revenue guidance to be between $1,850 million and $1,880 million, reflecting year-over-year growth of 39% at the midpoint of the range. We are improving our adjusted SG&A guidance to be between $325 million and $335 million. This represents adjusted SG&A as a percentage of total revenue of 17% to 18% and is an approximate 400 basis point decrease or improvement year-over-year at the midpoint of the range. This reflects our continued ability to gain operating leverage in our business as we grow. We are lowering both adjusted EBITDA and adjusted net income guidance to be between $15 million and $30 million. This primarily reflects pressures related to our greater proportion of new members relative to our returning member base and higher utilization trends. Lastly, we are updating our insurance BER guidance to a range of 90% to 91%, which reflects the elevated utilization trends we've seen this year, as well as the impact of our strong new membership growth. Our view of the long-term trajectory of the business and our confidence in our ability to achieve sustainable and increasing profitability is unchanged. We expect a meaningful increase in profitability in 2026, driven by multiple factors. First, we anticipate strong returning member retention with continued improved cohort economics, of our expected larger, profitable returning member cohorts, along with continued favorable performance from our year 3 and older cohorts. Second, a 4-star payment year for our PPO plans creates meaningful financial tailwinds, as approximately 97% of our members are enrolled in wide network PPO offerings. Third, continued focus on increasing Clover Assistant coverage and PCP adoption, and further investing in enhancing the platform's capabilities. Fourth, a focus on more cost-efficient growth channels. Fifth, a favorable impact from the Part C CMS final rate notice announced earlier this year, as well as from the significantly higher Part D direct subsidy. Lastly, we expect incremental efficiencies from continued SG&A leverage and optimization across variable, fixed, and growth expense categories. In summary, we continue to execute well against our long-term strategy. We are growing membership and revenue at an above-market pace while achieving adjusted EBITDA profitability year to date. Combined with a strong returning member cohort performance, Clover Assistant model differentiation, and multiple tailwinds, we believe that Clover is positioned well for meaningful adjusted EBITDA expansion in 2026 and beyond. Now I'll turn the call back to Andrew for closing comments.
In closing, despite margin pressure this year, we continue to deliver a stable underlying medical trend, high retention, and strong returning profitable member cohorts. As such, we remain comfortable with our go-forward medical cost trend heading into 2026 and feel confident to deliver continued profitability as our flywheel will spin even harder next year when we expect to have a larger returning member base managed by Clover Assistant. Importantly, Clover Assistant continues to perform exactly as designed, helping physicians identify and manage disease earlier, improving outcomes, and lowering costs over time. I remain excited about the potential we see for AI to improve the care received by our Clover members and all Medicare beneficiaries. I recently testified to Congress on AI in healthcare, where I emphasized that AI, when used properly, can be a powerful tool to drive clinical results and enhance members' access to personalized care. You can see this in our results. We recently published another clinical white paper highlighting how Clover Assistant helps PCPs provide better care for members in underserved communities. The analysis reveals more frequent identification of diabetes, CKD, COPD, and CHF among members from disadvantaged areas joining a Clover MA plan from another MA plan in the first year post-enrollment. We also see the diagnosis occur at earlier clinical stages of diabetes and CKD. The analysis also showed that members with any of these diseases of aging who were seeing CA-PCPs had less frequent hospitalizations and readmissions. These results reinforce that Clover Assistant not only helps improve outcomes across our plan, but also uniquely supports smaller, resource-constrained practices in both urban and rural underserved regions, where better data and coordinated care can make the greatest difference. Taken together, our strong growth, cohort management, disciplined execution, and expanding technology capabilities give us confidence in our ability to continue to achieve profitability in 2026 and beyond while growing above market. With that, let's open it up for questions.
Thank you. At this time, if you'd like to ask a question, please click on the raise hand button, which can be found on the black bar at the bottom of your screen. When it's your turn, you'll receive a message on your screen from the host allowing you to talk, and then you'll hear your name called. Please accept, unmute your audio, and ask your question. After every 2 questions, we'll move on to the next analyst in the queue. Once we've gone through the initial round, anyone who would like to ask a follow-up question is welcome to re-enter the queue by raising their hand again. We'll wait for a moment to allow the queue to form. Our first question will come from Jonathan Yong from UBS. Please unmute and ask your question.
Hey, thanks. Can you guys hear me?
Yep. Go ahead, Jonathan.
Yeah. Okay. Okay, thanks. Obviously, you got the elevated utilization in the quarter. Last quarter, you had pharmacy and dental issues, and now it's inpatient, outpatient, alongside other supplemental benefits. I'm trying to frame out how we should think about 2026 from a BER perspective. Like, I understand that the stars will be better, these cohorts will mature, but at the same time, you're also going to grow what seems to be fairly significant. And I'm fairly certain your benefits have gotten richer. So how do you plan on? Is there a mispricing issue that may have occurred for 2026 given what's occurring here, or are you fairly confident that this was encapsulated in your bids and that you won't see a problem in 26 given what you're kind of experiencing now with outsized growth, and that seems to be the driver of the pressure here?
Hey, Jonathan, it's Peter. Let me answer that question. So if you look at our earnings release and the prepared remarks, on a normalized basis, excluding prior year PPD, the underlying incurred cost trends, excluding pharmacy, is around 4%. So given the higher utilization trend that we see, and also the higher mix of new members, we think that's a solid performance. Now, like we said in the prepared remarks, we had expected to do better, so we'll work on that. For next year, I would say that cost trend roughly is baked into the bid as well. But that's just one part, right? We have a number of other tailwinds as well as the 4-star payment year, the rate notice on Part C, and of course the direct subsidy as well on Part D. So plus then SG&A increased leverage. That doesn't impact BER, of course, but so we feel that is baked into our bid. And then also, I would also say, like we said in the past, we're nuclear precise of where we do our marketing and target our growth. We're focusing on so-called priority markets that meet a couple of conditions. One, where we have a solid Clover member base already. We also have in those priority markets good coverage from a Clover Assistant perspective and home care perspective as well. So we're targeting growing in the areas that we want to grow, and that should also help BER go forward.
Okay, and then just looking at your guidance here, I think if I were to just kind of putting the numbers together here, it looks like the BER does step up, but if I look at kind of the core MCR basis, it almost seems to imply that it actually steps down. I'm just trying to understand, is there anything specific for how we should think about 4Q, or are you guys seeing anything specific that would seem to imply that it actually steps down, or maybe my math is wrong here? Thanks.
Are you looking at 3Q to 4Q or looking at 9 months into the fourth quarter?
3Q to 4Q, because it looks like you did an 89.5 in 3Q, and it seems to imply it steps down.
Exactly. Yeah, I think we can refer back to the prepared remarks in my section where we talked about essentially intra-year PPD from the second half impacting the third quarter. So the way to look at it is really averaging out the first 3 quarters to get to kind of like a baseline expectation for the fourth quarter.
Okay, thanks.
Yeah, thank you.
Thank you. As a reminder, if you do have a question, you can use the raised hand button at the bottom of your Zoom screen. I'll just wait for another moment to allow any further questions to form a queue. Okay, well, there are no further questions on the webinar. I'll now turn the call back over to Andrew Toy for any closing remarks.
All right, folks. Thanks, everyone, for joining us today. Thank you, Jonathan, for the questions. We appreciate everyone's continued interest in Clover, and we look forward to updating you all on our progress in the quarters ahead as we go into 2026. Have a great evening, everyone. Thank you.
That was kind of funny. One question. So there's a couple of things here, going private, and then all these other things that they were saying, and someone was saying dental was the issue, but I think BRAD, I think in terms of dental, they said that they're going to end up basically having that fixed, and and they're going to go ahead and basically focus on whatchamacallit, let me go ahead and share the screen normally here. Hold on. Share screen. Give me a moment here so I can switch it on over to here. Yeah, so you pretty much basically they said that the whole dental thing could basically be fixed. They're going to focus on the 1 star to 2 star rating for pharmacy. But really, again, guys, the big thing here is achieve full year GAAP net income in 2026 while also improving the EBITDA profitability. So full year GAAP this is like it's not like non-GAAP. This is like GAAP, right? So this is it's the real deal. So the fact that they gave us this, a lot of people are sleeping on this here, which I'm surprised. Honestly, I feel like this line here is probably one of the reasons why we're at $3 right now in the after hours. I mean, I would say if they didn't include this, and I would say, you know what, this would probably been a disaster of an earnings. But they said a couple things that were actually quite great. So a lot of folks don't understand that Part D is what basically hit them hard this year, right? And then they have inpatient, outpatient mix, which obviously they're going to be focused on. But the big thing here is that 4% increase plus that additional 9%. So about almost 14% increase, which is going to send them off to being full year GAAP profitable. I would say people forget this. Andrew Toy said that. So someone asked him, an analyst asked him on Q1 2025, or I believe also, was it in Q4? Either it was Q4 2024. It was like many quarters ago. He pretty much was asked about Counterpart, and he said, right now our goal is to become a fully profitable GAAP net income profitable plan. And then we can go ahead and talk about the SaaS company. So I think right now their mission is to achieve profitability. Now, they did not mention the Counterpart SaaS as to offset the revenue. They're saying that the profitable members are still going to help. I think it's like a 2 to 1 ratio, meaning that returning members offer 2x the profitable spend as the new members. So that's actually really good. It shows that the business model is succinct. But honestly, now it's a waiting game. Now, again, a lot of retail investors are going to want to, get out of this, or they're going to just all huff and puff. And, again, at the end of the day, this is a long-term play. They're on the crux of becoming a triple dragon, meaning, operational cash flow positive, free cash flow positive. And now we're going to get to that net income positive in 2026. And then if they can work hard, then they might be able in October 2026, we'll figure out if they are going to be 4 stars again. If not, maybe revised for year 2028, right? I believe once they become profitable from this full year GAAP net income, then they're going to end up basically talking about SaaS. I don't think SaaS is going to come in next year. Again, maybe I'm wrong. Perhaps I'm expecting it in 2027. So, I mean, from that perspective, I think this was good. Now, from his tone, Andrew Toy's tone, if I want to say something, honestly, I actually liked his tone. He was like, someone who's, I've been investing for a while now. And, when I like to, he was, because, that article that they published, they kind of steered away from saying 3.5 stars. He hit it head on, and he says, we want 4 stars. And he said it twice. and he was very, very direct. So they're definitely working hard. So from that perspective, I think they're loading the boat right now with revenue, almost like $500 million in revenue this quarter, which is pretty good, right? So ultimately, I think it's just kind of a waiting game now to get that SaaS numbers, but also to get to this to become profitable. So yeah, that's not bad, honestly. I think, and again, there's a lot of like whatchamacallit, issues happening in the market right now. If you go to Yahoo Finance, a lot of people from crypto land are like upset. They're saying that it's a bear market now, crypto winter, and all this other stuff here. But you can see the whole market's down right now. So I would say with the market being down, VIX being up, and then NASDAQ leads stock slide as tech gets pummeled. You got Michael Burry shorting Palantir. I would say what this is. For me, again, I can only speak upon myself. Don't again, nothing here is financial advice, but I was a bit skeptical. We were up a lot in October to a point where it was a new name called Uptober. And to be quite frankly honest, we rose up a lot, and so I would say if we can get back down lower, it'll be a lot better. And a lot of retail investors are most likely going to sell, and I think institutions are going to end up buying. And I honestly think that's the goal. I think they're quiet right now. Analysts are just like, whatever, we're not going to ask questions. They're not going to tell us anything. Again, because the thing is, Clover doesn't need any money for dilution. They're not asking any money from these analysts. They have a winning product. And right now it's pretty much, I've never heard Andrew Choi say it's a blue ocean. That's, he's not a splashy type guy. So he's not a splashy type guy. For some people, if you think SaaS is fake, then honestly, that's then go to Palantir. I don't know, go to the S&P 500. I don't know, right? I believe it's real, and I'm invested in it. Now, the beautiful part is I'm trying to get to 500,000 shares. So that's my goal. I'm at 440,000 now. I think actually 445,000. Forget the 5,000. It's like another small account, but so I just need about 60 more thousand shares. So if I can get that lower, I mean, if this thing can go down, hopefully to 250. I don't know if it will, but I mean, it will be nice. And if it can go down even lower, that'll be really great. Because the thing is, that'll cost me $150,000 rather than it costing me $220,000, which is an extra 72K. I don't want to pay an extra 72K. You see, only in the stock market do you ever find when something gets discounted, you find people upset. The value proposition is still here. The new growth members, there are going to be some growth pains. It's been a while for Clover Health. What is this? Oh yeah, it's been a while for Clover Health to grow. So just like what Andrew Choi said, this year is going to be a recalibration for them to patch any holes in the MA plan to make sure they're able to grow smoothly, right? So there's that. And then this new membership growth is ultimately going to serve as free revenue, pretty much free profitability, free profitability for next year. And that's I'm actually pretty impressed by this. The clinic, so you could see here the first year there's nothing, but the second year they get a 700 basis point reduction. And then the third year they get a 1400 basis point reduction, which I think they changed it. It used to be like 1500, I think, right? So if you take like 1400 minus 700, you get like 700, right? So they changed it. It used to be like 1500. Now they're saying 1400. And as you can see, kind of the cohorts here, right? So that's actually pretty good. That means that, sorry, I'm yawning here. The next year, this new growth of cohorts is pretty much going to be, 7% cheaper. So there's going to be a 7% reduction. So, which is why I think they're confident in their ability to say, hey, full year gap, right? And look at kind of SoFi, Palantir, what happened when they were full year gap. But let's just kind of do some math here, honestly. So let's go to hold on. Let's do some math here, no? So let's go here and let's go to financial data. Let's go here and then I don't know. Let's see. Let's look at CLOV here. Actually, let me go full screen here. So let's look at CLOV. So the revenue last year was 1371. And then this year they're guiding let me just use the right number. Let's use this bottom number now. Let's just use this. I know it's going to be more, but let's use the bottom number. It's going to be in the middle. Let's just use the bottom here, okay? And let's subtract these two numbers together. So that means this year, Clover is going to make an extra $478 million. If we take 178 million, and if we multiply that by 7%, which is 700 basis points, you get an extra 33.52 million added on, right? But remember, it's not just 7%. They're going to get 7% from their AI Clover Assistant. Then we're going to add another the 5% for the 4-star. Hold on for a sec. Sorry about that. That was Peter. He knocked on the door. I'm just kidding. No, okay. So, all right. So the dogs were going crazy here. So let me. So where was I? So 7% is what their AI is going to save them, and then another 7% in the next year. But remember, it's also going to be 7% from the year before. So and they're going to save another 7% off of the other. I mean, this is like a crazy flywheel model, right? Because it's 7% for the other year cohorts, an additional 7%. But let's just use this one. So 7% plus 5% plus 9%. That's about 21%. Like that's insane. So that 21%, if we go ahead and say this times 21%, that's $100 million that's going to be pretty much added into the jungle mix. And then that doesn't include Part D subsidies. That's extra revenue that they could potentially, we're not like calculating it correctly, but that it's an extra safe, protection. And if, let's say, if we want to basically say, you know what, let's just divide this out, and let's say to take 25%, so 75% margin of safety, that's about $25 million. So I'm expecting, maybe, who knows, we might get to, anywhere between 10 to $20 million in profitability next year. So we'll see what happens. And then all they need is to just get back to that 4-star rating. And I think we're going to be pretty good. Right. So just to kind of talk to you guys, Amazon, Jeff Bezos, Warren Buffett, they all wanted to create something like Clover. They all failed. I read this a long time ago, and I actually lost the article. One of our lifetime members found it. So a long time ago, Humana actually wanted to create something like Clover. So Humana launched a new venture called Author, which offers technology-driven healthcare plans for older people. The CEO of Humana said insurer startups like Clover Health prompted the new project. And you could go ahead and read this article. It's really great. So this is one of the reasons why I was looking at this, and I was like, well, okay, well, it's very clear that Humana's, Clover's already been on Humana's radar for a long time. And, that's now it's just a point of just execution. So, that's pretty much what I'm waiting for, is just a triple dragon, right? So at the end of the day, it's just a waiting game, right? And most people are like, waiting game. I've been waiting for a long time. Hey, you know what, man? If you don't like waiting, then maybe this may not be, the best. It just may not be the best. The stock market, unfortunately, is unfortunately, if you can't wait, then it is what it is. I mean, you do what you can do. I'm gonna wait because again here, Stanley Drunken Miller here says we mostly just sit around reading, thinking, and waiting. And a lot of folks, this guy has a net worth of $7.8 billion. Charlie Munger, RRP, a lot of folks have this type of thinking. So at the end of the day, I'm just waiting, right? I'm waiting. I'm accumulating. Institutions are accumulating. This is a flywheel model, and they just have to fix a couple of, a lot of people that invest in stocks, they probably never ran a business their whole life, right? There is issues that come up. Just look what happened to Palantir. They had to slow down their growth, which dropped the stock price to 7. People sold at 7, and now they're like literally ripping their eyeballs out, right? So there it is, right? And then the amount of shares that I have is like almost the size of some institutional players, which is pretty cool, right? So my conviction is strong. You're having, again, guys, we have not reached the top of this market, because I'm reading all of people's comments. And whenever you have, full year GAAP net income in 2026, and people are upset, it reflects the AAII retail investor sentiment, which is a reflection of dumb money, right? So I think we have a lot of gas in the tank. Now, technically, Bitcoin is prognostic to what's to come for the S&P. So potentially we might see a dip, or this might be some shakeout ultimately. But 2026 is only 2 months away, which is kind of sad, to be honest with you. It's kind of a little sad and depressing, given that 2025 is almost over. That's honestly the saddest part about all that. But it's just really kind of sad, honestly, how time's going by. But hey, we're closer to 2026. So that's good. So this is the outlook. They took a hit. They're upset. This year they're fixing it. Doesn't matter. Institutions are loading up. You have a lot of UBS is upset. They only ask one question. It doesn't matter. Who cares? Once they fix it next year and they achieve profitability, everyone's going to be excited. Retail, it's everyone's Wall Street still short-term thinking. And honestly, again, guys, at the end of the day, let the gazelle become gazelle. Let them be eaten off. Let them go back to their W-2 jobs. Those W-2s are not going to last forever, sadly, because robots are taking over. But just let the system let the system do its thing. Overall, guys, it was a pleasure. And I'll see you on the next one. I have a meeting to go to. But yeah, I'll see you on the next one. Peace out.